What is the stock market? The stock market is a collection of exchanges where publicly traded companies list their shares for buying and selling. It functions as a marketplace connecting buyers and sellers of ownership stakes in businesses. Major stock exchanges include the New York Stock Exchange, or NYSE, and Nasdaq in the United States. The stock market allows companies to raise capital for growth while giving investors opportunities to build wealth through company ownership. To summarize, the stock market is a collection of exchanges that facilitate trading of company shares, connecting buyers and sellers while serving the needs of both companies and investors. When you buy a stock, you're purchasing a small ownership piece of a company. These ownership pieces are called shares, and they represent your stake in the company. As a shareholder, you're entitled to certain rights and benefits. These include a portion of the company's profits, voting rights at shareholder meetings, and a claim on the company's assets. Companies issue shares to raise money for various business needs. When investors buy shares, they provide capital to the company in exchange for ownership stakes. This capital can be used for business operations, expansion, new projects, or paying off debt. The value of shares fluctuates based on various factors. Company performance includes earnings, growth potential, management quality, and product success. Market conditions such as interest rates, economic growth, and industry trends also play a major role. And investor sentiment, driven by confidence levels, news, and future outlook, can significantly impact stock prices. Stocks can provide returns to investors through two main ways. First, price appreciation occurs when the share price increases over time, allowing you to sell your shares for more than you paid. Second, dividends are a portion of the company's profits distributed to shareholders, providing regular income regardless of share price. Stock markets cycle between bullish and bearish periods. Understanding these market cycles is crucial for investors. A bull market occurs when stock prices rise consistently by 20% or more over an extended period. It reflects investor optimism and economic growth. A bear market happens when prices fall significantly, at least 20% from recent highs. Bear markets indicate economic concerns and investor pessimism. Markets move in cycles between bullish and bearish periods. These cycles are inevitable and typically influenced by economic conditions, interest rates, and investor sentiment. Different market conditions call for different investment approaches. In bull markets, investors often focus on growth and may take on more risk. During bear markets, defensive strategies and quality become more important. Understanding these market cycles helps investors develop appropriate strategies and prepare for inevitable market fluctuations. Before diving into the stock market, establish clear financial goals and determine how much you can comfortably invest. Open a brokerage account with an established firm like Fidelity, Charles Schwab, or online platforms like Robinhood. Each offers different features, but most now charge zero commission on standard trades. Once you've selected a broker, funding your account is straightforward. Link your bank account, transfer funds, verify the deposit, and you're ready to invest. For beginners, index funds or ETFs are recommended as they provide instant diversification across many companies. They require less research and carry lower risk compared to individual stocks. Over time, a simple index fund investment can grow significantly. Most brokerages offer educational resources and research tools to help you make informed decisions as you gain experience. As a beginner, it's wise to start with small amounts while you learn. Consider investing just $50 or $100 at first to get comfortable with the process. One of the most effective strategies for beginners is dollar cost averaging, where you invest a fixed amount regularly regardless of market conditions. This reduces the impact of market volatility and removes the pressure of trying to time the market perfectly. Remember, consistency is the key to long-term investment success. By starting small, investing regularly, and gradually increasing your knowledge, you'll build confidence as an investor. Understanding stock indices is essential for any investor. Stock indices track the performance of specific groups of stocks, providing a snapshot of market performance. Let's explore some of the major stock indices used around the world. The S&P 500 tracks 500 large U.S. companies across various industries. The Dow Jones Industrial Average follows 30 significant stocks that represent the U.S. economy. The Nasdaq Composite focuses primarily on technology companies and includes over 3,000 stocks. Stock indices exist around the world to track different markets. Global indices include Japan's Nikkei 225 and the UK's A100. Let's compare how different indices have performed over time. Each index follows its own pattern based on the companies it tracks. These benchmarks help investors in several ways. First, indices help investors gauge overall market trends, showing whether markets are generally rising or falling. Second, they provide a benchmark for comparing investment performance. Investors often measure their returns against relevant indices. Finally, indices guide portfolio allocation decisions, helping investors distribute their investments across different sectors and regions. Investors use two main approaches to evaluate stocks: fundamental analysis and technical analysis. Fundamental analysis examines company financials, management, competitive advantages, and industry trends to determine a stock's intrinsic value. Key metrics include price-to-earnings ratios, debt levels, revenue growth, profit margins, and cash flow. The ultimate goal is to determine the intrinsic value of a stock. Technical analysis, on the other hand, studies price movements and trading volumes using charts and patterns to predict future price behavior. Traders look at historical price charts and identify patterns that might indicate future movement. They use technical indicators like moving averages, relative strength index, and support and resistance levels. Most successful investors incorporate elements of both approaches, using fundamentals to select quality companies and technical indicators to optimize entry and exit points can lead to improved investment decisions. As a key takeaway, remember that fundamental analysis helps with long-term value assessment, while technical analysis aids with short-term timing. Combining both approaches can provide a more complete investment strategy. Dividends are regular payments that companies distribute to their shareholders from profits. When a company generates profit, its board of directors may decide to return a portion of those profits to shareholders in the form of dividends. Income investing focuses on stocks that pay consistent, growing dividend payments, rather than solely aiming for price appreciation. While growth investors seek companies that reinvest profits into expansion, income investors prefer companies that share profits with shareholders through dividends. This chart shows the different approaches. Growth stocks may offer higher price appreciation over time, while income stocks provide regular dividend payments along with moderate growth. Dividend yield is a critical metric for income investors. It represents the annual dividend income as a percentage of the current stock price. For example, if a company's stock costs $50 and pays an annual dividend of $2, the dividend yield would be 4%. This metric helps investors compare the income potential across different investments, regardless of their share prices. Dividend aristocrats are elite companies that have not only paid, but increased their dividends for at least 25 consecutive years. These companies demonstrate exceptional financial stability and a strong commitment to returning value to shareholders. As shown in this chart, dividend aristocrats provide consistently growing income over time, which is highly valuable for income investors. Reinvesting dividends can significantly boost returns through the power of compounding. This chart shows the difference between taking dividends as cash versus reinvesting them back into the same stock. Over 30 years, a $1,000 investment might grow to $32,000 without reinvesting dividends. But with dividend reinvestment, the same investment could reach $100,000. Income investing is particularly popular among retirees seeking regular cash flow from their investments. Unlike growth investors who may need to sell shares to generate cash, Income investors can live off their dividend payments without depleting their principal. This approach offers several key benefits for retirees, including a reliable income stream, preservation of capital, and potential inflation protection through growing dividends. Let's examine common investing mistakes that can significantly impact your returns. Emotional decision-making is perhaps the most common mistake. Investors often panic sell during market downturns, locking in losses. On the flip side, fear of missing out, or FOMO, leads to buying near market peaks when everyone is optimistic. A better approach is to stick to your investment plan and make decisions based on your long-term goals, not short-term emotions. Many investors try to time the market, buying low and selling high, but research shows this is nearly impossible to do consistently. Consistent investing typically outperforms market timing. Missing just a few of the market's best days can dramatically reduce your long-term returns. A better approach is dollar cost averaging, investing a fixed amount regularly, regardless of market conditions. Another common mistake is overconcentration in trendy sectors or individual stocks, especially in technology or the latest hot industry. When that trendy sector inevitably goes through a downturn, your portfolio can suffer dramatic losses. This has happened repeatedly with technology bubbles. A better approach is diversification across multiple sectors, geographic regions, and asset classes to reduce your overall portfolio risk. Many investors underestimate the impact of fees and taxes on their investment returns. Even small differences in expense ratios can significantly impact long-term performance. For example, over 30 years, a 1.5 percentage point difference in fees can reduce your returns by tens of thousands of dollars. A better approach is to choose low-cost index funds and be strategic about tax efficiency in your investment choices. A major mistake is investing before establishing a solid financial foundation. This includes investing while carrying high-interest debt or before building an emergency fund. Without this foundation, you may be forced to sell investments at inopportune times to cover unexpected expenses, potentially locking in losses. A better approach is to pay off high-interest debt and build an emergency fund of 3 to 6 months of expenses before focusing on long-term investments. Finally, many investors fail to properly research their investments. They rely on social media tips, follow trends, or act on news headlines without proper analysis. This approach significantly increases your risk and often leads to poor investment outcomes. A better approach is to develop a systematic research process and truly understand the investments you own and why you own them. By learning from these common mistakes, you can improve your investing journey and potentially increase your returns over time.